Welcome to the Investopedia Express Conversation Series. This is our space to talk to some of the most influential investors, strategists, advisors, academics, policymakers, journalists, and entrepreneurs in the world of finance, economics, and investing. Today's conversation is with Steve Eisman. Some of you might remember his name from The Big Short, the terrific book by Michael Lewis about the great financial crisis, later turned into an award-winning movie starring Steve Carell and Ryan Gosling, among others. Steve Eisman, the real Steve Eisman, has made an investing career out of seeing around corners and swimming upstream against the Wall Street herd. His bet against the U.S. housing market during the financial crisis, shorting mortgage-backed securities, was unpopular at the time, but unbelievably prescient. Today, as volatility has returned to the stock market with a vengeance in response to the new administration's aggressive tariff policies, we welcome Steve Eisman's take on where we are and where we are headed as investors, and we welcome him to the Investopedia Express. Thanks for being here.
That's some introduction. I hope I can live up to it.
I don't know if I can do that again. That took a lot of breath out of me. So I've heard you talk in recent days and weeks about what's happening with the tariff situation. What are most investors getting wrong about the tariffs?
It's not that they're necessarily getting it wrong. It's a real paradigm jarring event for them. Everybody in our socioeconomic class went to college. Everybody took Econ 101. And we were all taught trade is good, tariffs are bad, trade wars are terrible. The problem is that, if you go back in time to the 90s when President Clinton sold NAFTA and getting China into the WTO, he sold it based on two fundamental arguments. He argued that GDP growth would accelerate and a lot of jobs would get created. And he was 100% right about the former, and he was 1,000% wrong about the latter. But he ushered in a big bull market. So, people in the market love the whole free trade bull market story. Who doesn't? We all made a lot of money at it. But half the country got obliterated. If you travel through the South, Midwest, Indiana, basically places that J.D. Vance comes from, people didn't just lose their livelihood. They lost their homes. They lost their towns. And what I think President Trump is trying to argue, and I have some sympathy for this, is that GDP is not just a number. It's composed of people. And some people really won over the last 30 years, and a lot of people really lost. What he's trying to do is level the playing field in terms of trade and bring a lot of jobs back. If that's your goal, and that is obviously his goal, you're not going to get there by being nice. You're going to use tariffs as a cudgel, as a weapon. And that's what I think is happening. But because everybody seriously believes in free trade and is petrified of a trade war, the market is having some real serious emotional problems right now.
It's a resetting of the global economic landscape, to say the least. But you say some people won. I assume you mean shareholders won, because what happened during that time? We had technological innovation.
A big bull market. We had offshoring. We had deflation. The people who benefited from that were people who invested in the stock market, people who invented tech companies, and people who reshored a lot of their businesses overseas. The people who lost are the people who don't invest in the stock market and work in factories.
Can we have that type of an economy, a manufacturing economy? Can we bring those jobs back and restructure the American economy in the age of AI, in the age of robotics and productivity? I know you're bullish AI, you're bullish on what you've seen in terms of technology and what that's done for productivity for companies. Can we actually have both in this country?
I think we certainly have some of both. Some businesses will get reshored. I have a feeling that one of the things the Trump administration is going to do in the tax bill that they're trying to pass is 100% write-offs if you build a factory in the United States. That's a pretty big incentive to build a factory in the United States. So do I think we're going to make T-shirts again in the United States? Probably not. Do I think we're going to make auto parts? Maybe we'll make a lot more of that kind of stuff. But, a lot of people are going to have jobs that they wouldn't otherwise have, and they'll pay pretty well.
Part of the sell-off, or the narrative around the sell-off, and I know you're a big believer in narratives, is that this is a restructuring of the global economy. We're becoming much more insulated as a country. We have to reshape our economy and put people back to work here. Can you do that and still grow profit margins? And can companies still have the ability to grow profits over the long term? Because as investors, that's what we're here for, right? Long-term profit growth. And when you look at how long this might take and what it might mean if companies have to actually pay fair wages to their workers.
Oh, God forbid they should pay fair wages.
I know, but what does that mean for corporate profits and then therefore for long-term investing horizons?
Well, does that mean that profit margins might get hurt in the near term? It's certainly possible. But on the other hand, if you take a page out of Henry Ford, he paid his workers a lot so they could buy cars. What would most of the American people prefer? Would they prefer to, live in bad towns in the Midwest but be able to buy cheap T-shirts? Or would they prefer to have really good jobs where maybe they're paying more for those T-shirts or some other things? I think that certainly the people who voted for President Trump would prefer the latter. The people in the market probably prefer the former. But they didn't bring him into power. He doesn't owe very much to them.
And those in power, and especially with the concentration of power now, if you look at Congress, if you look at what's happening in the judiciary, can make a lot of policy moves on their own. And that's what we've seen so far. So during this sell-off over the past few weeks, I know you're an observer of the market and an investor in it. What broke? Besides the fact that we got a leveling of PE ratios, we got a leveling of stock prices, especially in some of the most widely held stocks.
I think what broke was it's very emotionally jarring for people in the markets to actually realize. I don't think they took Trump seriously. I mean, you could like Trump, you could dislike Trump, but I actually think one thing I actually find admirable is that he's one of the few politicians I've ever seen in my lifetime where he actually does what he says he's going to do. This is not a surprise. He campaigned on this. I just think that it's so jarring to what everybody was taught in college. They didn't actually believe that it would actually happen. And now that it's actually here, everybody's like, oh my God, he was actually serious. I can't believe it. I think that's what's happened. It's a reset about what they were expecting from President Trump.
Do you think a level of trust has been broken in terms of especially individual retail investors and the capital markets and the way this economy was supposed to be? Do you think that there's been any sort of breach of that? Or is this just, again, a shock?
I think it's just a shock to the system.
You became more well-known through the great financial crisis and then through Michael Lewis's terrific book, but you've been observing markets for a very long time and you've seen big sell-offs before. Obviously, that was a big one. The COVID sell-off was another big one. This one's different because it is that shock and it is sort of a restructuring of the way our economy works or may work in the future. But is there anything that you think is similar to this, 1987, the great financial crisis, the COVID shutdown, and just in terms of the sell-off and just that lack of confidence on the part of investors?
There's certain things about the American economy that I still like a lot. The U.S. economy is more dynamic than it's ever been in our lifetimes. That's a positive. The other positive is that the financial system in the United States is finally safe. So I'm not expecting any bank to blow up. I don't think this is a crisis. I think this is people having fear that maybe there'll be a global recession. If there's a full-blown trade war, there probably will be a global recession. But at the end of the day, whatever happens, the U.S. is in the best position possible of any country on planet Earth to deal with this situation because the United States is the least dependent upon exports pretty much of any country in the world. Only 11% of our GDP comes from exports. China is probably, if you factor in all the stuff that they ship through Vietnam and Cambodia, is probably 30%. Canada and Mexico are 35%. Europe is anywhere from over 30% to, in the case of Germany, over 40%. So my expectation is if people are rational, and that's a big if, all these countries are going to send their representatives to the United States, and I actually know for a fact most of them are here already, to negotiate. They're going to try and negotiate as good a deal as possible. And the U.S. has most of the cards. Now, the wild card is not everybody's completely rational and emotions get involved. And, some politicians might worry that if they cave to Trump, they'll get thrown out of office. That's the wild card. If everybody's rational, Trump will get most of what he wants.
There has been a lot of talk about the risk of de-dollarization, a lot of countries forming in their own alliances. We know what's happening with the CRINCs, the China, Russia, India, and North Koreas of the world. Obviously, that's been happening in the PAC Rim. Europe has been talking about strengthening itself, but also doing more business with China and potentially Africa. What do you think the risk of the de-dollarization is? Do you think that will ever happen where the dollar just loses its status as, the most important currency and the most widely held and trusted in the world?
At this point, that's not a risk I take at all seriously. People talk about de-dollarization, but you have to understand, like I do, about how the global financial system actually works. The global financial system works on treasuries. Banks do overnight repos in treasuries. Everything is done in treasuries, which means it's done in dollars. So for there to be a de-dollarization, you need a potential replacement for treasuries. Right now, that doesn't mean that eventually there might not be some sort of replacement. But right now, there is no substitute for treasuries on planet Earth. It's certainly not crypto. It's not Chinese bonds. It's not EU bonds. So as long as that's the case, I think de-dollarization the risk is extremely low.
Which led me to my next question, which you answered, which is what if the biggest holders of our treasury bonds outside the United States decide they don't want to hold them anymore.
Same problem.
What are they going
to hold? There's no alternative.
Tina.
If you're a big, sovereign wealth fund, massive pension fund, and you have to hold something very liquid that's safe, there's no alternative to treasuries. Now, like I said, if one day there'll be an alternative to treasuries, we could have a different conversation. But until then, I don't think it's much of a risk.
Going into the end of the year, into the new year, you're, like a lot of people, bullish on AI, artificial intelligence, not necessarily the stocks in the sector, but the technological revolution that it's bringing.
Yeah.
What's your take on it now, and just in terms of where we are in the cycle, the investing cycle of that? Because we had a lot of super scaling going on. We had a lot of spending and a lot of promises of spending, which arguably propped up some of the biggest stocks in the market, like the NVIDIAs of the world and others. Where are we in that cycle, or what inning are we in, so to speak?
It's like inning 1.5. All that you've had so far is some invention of AI, which people are starting to use. No real other apps. A lot of spending in technology. One thing that made me realize that it's so early is if you listen to the conference calls of Accenture, which can be very interesting. Accenture has really two businesses. They have a consulting business and they have an outsourcing business. And the consulting business is not doing that well, but the outsourcing business is doing very well. And the reason why the outsourcing business is doing so well is that most companies in the world, their databases are not set up yet in one place where the data is easy to use so that these companies can actually do something with AI. They're outsourcing all that to Accenture to basically pool it all together. If that's where most companies are, it's inning one.
And the other side of that is the infrastructure build out, which we need. We're going to need a lot of energy
Tremendous.
to power all these AI centers.
Yes.
And arguably our energy infrastructure is due for an update or two. And that's why you saw so many of the energy companies, especially those supplying data centers, do so well in 2024. But what does a scaling of our energy needs look like in order to fulfill what could be the promise of artificial intelligence?
Well, if you just think about it from an electricity perspective, the United States, I believe, produces something like 4,000 terawatt hours of electricity per year. It's growing about 2.5–3% now per year. So in 10 years, you're going to get to 5,000 terawatt hours. So that's a lot of terawatt hours. You're going to add 1,000. And then assuming that we're still retiring coal plants, which utilities seem to be doing, that'll take about 500 terawatt hours out. So you're going to have to build 1,500 terawatt hours in the United States over the next 10 years or so. You're not going to get there with solar. It's just not reliable enough. And you're certainly not going to get there with wind. You'll get some of that there. My guess is that you're going to get there through a combination of wind turbine electrical power plants, maybe some nuclear, and maybe something we don't know. But one of the big stories, I think, over the next 10 years is going to be the production of gas turbines to create all this electricity.
We're going to need more power. Now, you say you don't short anymore. You're obviously, in the book because of your massive short and your prescient bet on the housing market and the collapse of the housing market back in 2008. Why don't you short anymore? And if you were to, again, do you see any sectors or any parts of the economy or the industrial sector where you might want to do that?
I mean, look, if I thought that a recession was coming, there's a whole bunch of specialty finance companies that I would short, because when credit quality starts to deteriorate, those companies perform bad very, very rapidly. I don't see that yet, so I don't see a lot of shorting opportunities. I mean, right now, it's all binary. If I was running my hedge fund right now, I would just simply be reducing risk on both sides of the book. The problem is that if you were adding to shorts and then some headline shows up that's very, a rumor is that President Trump's going to suspend the tariffs for 90 days, you'll be hospitalized. So right now, I would say to people, don't be a hero. Own the stock that you want to own. Prune from your portfolio the extraneous stuff that you don't have a lot of confidence in, and wait. Things will be clearer in a few months. They're certainly not going to be clearer in a couple of days. I mean, President Trump just imposed the tariffs last week. It's not even a week. Tomorrow will be a week. So, the idea that he's going to suspend the tariffs, you were hearing people on Wall Street say, please suspend the tariffs for 90 days. Why would he do that? He's getting all these countries to come to the negotiating table already. Vietnam, for example, proposed they would reduce the tariffs to 0. And Navarro said, that's not enough. They'll come back with more. So why would you take away your bazooka?
Why negotiate against yourself?
Right. Why do they? You just started.
Makes sense. What's not getting enough attention right now that you think deserves a little bit more focus in the capital markets?
What I would say is, I remember at some point in 2007, I got a call from a portfolio manager, another hedge fund that I was friendly with. And he says to me, have you heard of this term SIV, which means structured investment vehicle? And I said to him, I don't know anything about it, but I'll get back to you. And so we did a lot of homework. And what my partners and I realized that we actually thought we knew everything. And we realized there's a lot out there that could blow up that we don't even know about. And what I worry about now is, it's been a bull market for a very, very long time. A lot of complacency. What I worry about is what I don't know. Is there something out there, some structure out there that I don't know, somebody out there that I don't know that's going to be in trouble? And we won't know about it till it's too late.
As an independent investor now with more latitude to kind of look into what you want to look into, you got your podcast, the Eisman Playbook, out there now. But how do you do the research? What are you reading? What do you get up and read now that you can actually decide what you want to read and what you want to look into?
I read a lot of boutique research. I find that, and this is not always true, but I find that a lot of the boutique research sell-side firms, mostly because they're not conflicted, because they really don't do much, either any investment banking or much investment banking, produce research that I find very useful. And I spend a lot of time reading that.
Let's take it back to The Big Short. Obviously, that probably changed your career, made you a lot more popular and recognizable by a lot of people, at least your name. How did that change your life, if at all, once that came out?
I don't know if it changed it changed my life in the sense that, and this is going to sound a little funny, I've become a bit of a cult figure amongst young people. I didn't know this for years. I mean, it turns out that the book and the movie are so popular that pretty much in every university in the world, if you take an economics class, it's like required reading or required viewing. So it's very flattering. Funny story. My wife and I were in Italy, in Rome, last summer. And one of my favorite places in the whole world is the Pantheon. So we go to the Pantheon, and afterwards we're trying to go someplace else. We order an Uber, and we're standing in this itty bitty palazzo right next to the Pantheon. I mean, it's tiny. And there's two little restaurants in there. And I'm standing there and I look like a schlub. I mean, I'm wearing a Yankees baseball hat. I'm wearing a ratty t-shirt. I look almost homeless. I mean, I'm wearing, sandals that my wife can't stand. And I'm just standing there reading the news on my phone, waiting for the car. And all of a sudden, one of the Italian waiters from the restaurant walks over with another waiter. He and she walk over to me and he says to me, "Excuse me, are you Steve Eisman?" And my wife goes like this, and I turn to her and I go, "The legend grows." And so I have to say, it's a little strange that I'm recognized sometimes all over the world. It's very flattering.
What did you think about Steve Carell? Is he well cast?
I thought he did a fantastic job. And I have to tell you that I was actually petrified. I was fairly rude and obnoxious back then. I'm better now. And as my wife would say, the road between portraying me as a good person versus a jerk is a very small one.
He walked the line.
And he walked that line really well.
Yeah, he did a phenomenal job in Adam McKay, a phenomenal script, and the book is tremendous. Did you ever get to meet him? I assume you must have at some premieres.
I met him like twice. I met him for breakfast at the Three Guys that used to exist there. He wore a baseball hat so nobody would recognize him, and we had breakfast.
Did he want to pick your brain?
They picked my brain for a good hour.
That's amazing. Again, these days you're up to your podcast, which is also on YouTube, the Eisman Playbook. What are you trying to get across by having your own platform?
I'm trying to give back. I really like to teach. And so what I'm trying to do is I know every sell-side analyst on planet Earth. And so what I'm going to do is, over an hour, really go in depth with some of these people and other guests as well. For example, I'm I'll be speaking to an analyst this Thursday who covers media. And we're going to do a real in-depth, what has happened to the media landscape over the last 20 years, which when you think about it, obviously is extraordinary. We're going to go back. I basically going to say to him is, let's go back to 2005. Describe to me what the world was like then, and let's talk about how we got here.
Yeah, just the last 2 or 3 years alone in the media have been
Going to make you dizzy.
Very dizzy, and who knows where it's going from here. But let me know. I'll tune in to the Eisman playbook to listen to where the media is going, because we are a part of it. All right, Investopedia is a site built on our investing terms and our dictionary. Would love to know Steve Eisman's favorite investing term.
So I have a term that I use a lot that's not per se an investing term, but I think it applies a lot.
Life terms are acceptable,
which is the word paradigm. The modern meaning of the word was actually invented by Thomas Kuhn, who wrote a book about scientific revolutions in 1962, which I'll admit was the year I was born. What it basically says is that paradigms can exist in anything, and they can end in only one of two ways. Either over time it becomes clear that there's something really wrong with it, or people get hit over the head with a 2x4 and they realize, oh my God, my paradigm's really wrong. The financial crisis was a 2x4. What's happening now, if things, it's going to be more of a slow bleed.
Well, we will brace ourselves for that. Steve Eisman, find him on the Eisman Playbook, and so good to have you on the Investopedia Express Conversation Series. Thanks so much for your time.
Glad to be here.